Okay, hi everyone. Let's kickstart the Money Show that's been delayed because of the flow of news that's been coming in non-stop, not just in the last 15 minutes, but all day. It's been a busy day at ET now. But the Money Show is, of course, dedicated to your money, your personal finance, your mutual funds, and we've got your back for any questions or queries as well that you may be having. So in this shortened edition of the Money Show, I'd request all our viewers to instantly keep their questions and queries ready on the funds they have, on changes they'd like to make in their mutual fund portfolio. You can call in on 24990300. Today we have with us Anil Rego, founder and CEO of Right Horizons, to talk about money-making strategies via mutual funds, even if that may not be your full-time profession in the world of finances and equities. Mr. Rego, thank you so much for joining in on this episode of the show and this edition of the show. One basic question that we often are asked is that, yes, you do say that investing in mutual funds can help create wealth. It's a great way to save money and to generate wealth for the long term, for your retirement, for general wealth creation. But a lot of times people ask this question: how do you even choose a mutual fund in the first place? You've got to start somewhere, right? So where do you start? How should you choose a mutual fund, Mr. Rego?
Yeah, so it's not as simple as it seems, because there are a whole lot of categories of mutual funds, and on top of that, maybe each fund house has its own scheme. So or most of the fund houses have their own scheme. So you have a large number of schemes to choose from. Now, where do you start? I think the starting point is to understand your own requirements and your own needs, because based on that you can come out with a strategy. So ideal to do a financial plan, or at least a bit of an assessment to understand your own risk profile. And based on your risk profile, you can end up saying that, okay, I will have a 60% equity or 40% debt exposure. So that's the first aspect to look at. What is the asset allocation between, say, equity, debt, and possibly gold? That's based on your own risk appetite, and this will vary from individual to individual. The next step would be to get into looking at what are the funds within equity. It's again good to diversify across maybe various categories. You have the large cap, the multi cap, and then you have the mid and small cap. So of course there are many more categories, but these are the four basic ones, and you can then choose a certain allocation within. Okay, so in terms of how much you want to set aside for large cap funds, how much you want to set aside for multi cap, etc. And the next stage would then go to choosing your exact scheme. Now, let's assume that you're looking at this large cap category, and so within that, you can do a bit of a shortlisting, combination of performance, because most people only look at performance and end up seeing that your fund is pretty volatile. Second is, you should not be looking at too short-term performance. 1 year also can be a bit of a short-term, because you may find that, okay, this year you have a scheme which has done very well for the last 1 year, and then you enter into it and the next year it does poorly. So look at maybe 3 years, 5 years, etc. Also look at risk measures, and I think this is sort of many times left out. It's good to have a fund with a better risk-adjusted return, which means that if it's less risky and it's less volatile, basically, you'll find that the fund may deliver you the same return, but your experience will be much better. It's not going to vary as much. So I think these are the 3-4 maybe simple steps that you need to do. Similarly, you need to also do the same thing within the debt category, because there also you have long-term funds, you have short-term, medium-term funds, you have liquid, you have ultra short-term. So there are a whole lot of options which are available. So I think follow a bit of a top-down approach based on your requirements, and then get down to choosing your fund. Now there are a lot of rankings which are also available, which can help you. Value Research, Money Control, etc. All give you rankings, and you can end up looking at some of those to help you also make that decision.
Okay, all right. Mr. Rego, what is the perfect bifurcation? Because, of course, you shouldn't have everything in mutual funds. You should have something in maybe a fixed deposit, a little something in public provident fund as well. So what's the ideal split between equity and debt for various ages?
Yeah, so a thumb rule that people use is to say, 100 minus your age. So if you are a say 60-year-old person, so 100 minus 60, which means you can take a 40% equity exposure. Similarly, if you're a 40-year-old, then you can take a 60% equity exposure. Now, yes, like you said, you can use multiple avenues. Mutual fund is sort of one of them, and even within equities, you may choose to do stocks if you are a good stock picker, etc. Similarly, on the debt side, you may choose bank fixed deposits. You may choose the PPF avenues, which are also tax efficient, like PPF. So you need to look at what you want within mutual funds, what you want outside mutual funds as well. And again, that will vary based on your own preferences, because some person may not be comfortable with a very long-term lock-in. Let's say that a PPF has somebody else within a low tax bracket also may not gain as much relatively. So it needs to be based a lot on what your own criteria is, your own preferences, and possibly your risk profile.
Okay, and within mutual funds, like you mentioned, there are many kinds of categories like large cap, small cap, mid cap, multi cap, hybrid. So what should be the split among these then?
Yeah, so again, like I said, it depends on your own risk profile. But let's say, for somebody who is, let's say, a 40-year-old, maybe you can just say equally, distribute across large multi-cap, mid-cap, and maybe small cap, or even just have three of them within the mid-cap and small cap. You can sort of categorize together. Now, it would depend, because for somebody who is let's say a higher age, and depending on this income, say to take care of your own say monthly expenses when you're in retirement, then you would bring in say hybrid funds. So a lot of it has to be with your own criteria, and I think there's a lot of material available online which you can sort of read. I think it's good, because let's say on a TV show there's only so much you can tell, but I think you need to also go back and do your own research and come back and study it, and you are also in a better position to make your investment decisions. And if you're not able to, then possibly use a financial advisor who can sort of guide you through that.
Okay, well, on that note, let's kickstart our Ask the Money Show segment, where we invite you, the viewers, to ask any questions or queries that you may be having with respect to your mutual fund portfolio. And we already have our very first caller. Mukesh is joining us on the phone line from Mumbai. Hi, Mukesh. Good evening. What's your question?
Yeah, good evening. See, my question is, I have invested about 25 lakhs in equity stock market.
Okay.
And now I want to invest about 5 lakhs in mutual funds.
Okay.
So how do I go about it? If you can suggest me 4 or 5 mutual funds where my horizon for the return is minimum 3 years, maybe 5 or 6 years.
Okay,
so
all right.
Mutual funds
that you could invest in.
Suggest. Yeah.
You're in the equity markets. You've invested the 35 lakhs, or is it trading? I'm assuming it's invested.
No, equity market. I'm a regular investor, and at the moment the investment is roughly around 25 lakhs.
Okay, all right. Okay, so he already does have exposure to equities, which is almost about 30 odd lakh rupees, and now he also has an additional 5 lakh rupees spare that he thinks he should now put in mutual funds. So, Mr. Rego, do you think he'll be overexposing himself to equities if he puts a good now almost there's already an amount lying, now he wants to put in an extra 5 lakh rupees? How would you recommend he go about?
Yes, I'm not sure what his portfolio is beyond the equity side, so it's possible that he also has a few assets on the debt side. But let's assume that one wants to put it into equities, and he has covered himself on the debt side. And in that case, possibly in a market condition like now, I would think that he could use a multi-cap and a combination maybe of multi-cap and a mid-cap. You could even do it systematically or choose to do it one time. When I'm saying systematically, he has a lump sum, so he can park it in a liquid fund or an ultra short-term fund, and can do a systematic transfer, say even over 3 to 6 months, possibly on a weekly basis. Okay, so that just in case there's market volatility, you're not getting caught in it. Of course, if he's an equity investor, so I'm sure he has a perspective of timing the market, etc., and how comfortable he is. So possibly based on that, he can even choose to do part of it lump sum, maybe part of it systematically. And I think on a 5 lakh basis, I guess two funds should be enough. Maybe one on, so I say the multi-cap. You can do a Kotak standard multi-cap, and in the mid-cap possibly an Axis mid-cap fund.
Okay, so those are the recommendations, Mukesh. I hope that will help you kickstart your journey in the mutual fund world as well. All right, we have Tushar joining us on the phone line from Nashik. Tushar, hi, good evening. Thank you for calling in. What's your query?
Good evening. I regularly invest in equity as well as debt mutual funds.
Okay.
But to have, and I also have ICICI Balance Advantage Fund. But to have the exposure to gold, I'm thinking of going into multi-asset allocation fund.
Okay.
One, is it a good idea? And second is, which is the one you recommend? I want to invest for a long-term basis.
So you have mutual funds and you have equity exposure as well. And now you're thinking that you want to put in some money in gold. And why not, right? It's at 42,000 now, I suppose. So, Mr. Rego, purely from an investment perspective, I'm just going to ask some more questions on Tushar's behalf in case if he wants to know about this. Purely from an investment perspective, if gold prices are now at roughly around 42,000, the last time I checked, is it a good time to buy at this juncture? B, is a multi-asset allocation fund the best way to get exposure in gold? And C, if yes, if you could also recommend, Tushar with some names.
No, so I think at a point like this, since he already has equity and he does have some weight around that, I would think maybe a better way to do is to just use a gold fund itself, either a gold ETF or maybe even a gold savings fund. Because we can use it through a systematic mode. Now, the reason why I'm suggesting that is because also, like you mentioned, gold has done well, and the tendency for us is to see, okay, some asset performs well and then I jump in. It still maybe, in our view, gold can continue to do well for some more time, but we could see some bit of volatility, especially that since we've seen volatility around what's happened in Iran. So, and as tensions ease off, you may see suddenly it come down sometime, if it go up. Okay, so, but I think on a 2-3 year basis, we are reasonably bullish on gold. So, one way to do it is just to, have a separate allocation to it, maybe a 3% and possibly go up to 5% systematically, so that you're not putting it all at one time. Yeah, so if you want to look at a multi-asset fund, I think possibly in my view, ICICI is a good option to look at their multi-asset fund.
Okay, ICICI multi-asset fund would be a good option to look at. I hope, Tushar, this will help you with your question. Ajay Srivastav joins us now on the phone line from Pune. Hi, Ajay, good evening. What's your query?
Good evening. I'm 54 years old.
Okay.
And me and my wife both are working.
Mm-hmm.
We have 2 children. One is studying, one is working. Okay. I don't have any other requirements. I have equity exposure in equity mutual fund of about 1.2 CR.
Okay.
And I have debt also of about 1.1.
Okay.
Which is my PF, etc.
Okay.
Now, in the equity exposure, I have more than 50% is in large cap.
Mm-hmm.
I have Axis blue chip, I have Franklin Templeton blue chip, and I have ICICI Pru blue chip.
Okay.
And I have the balance in mid cap and small cap.
Okay.
Now, I would be retiring from my service at the age of 60.
Okay.
And I have a pensionable service.
Okay, so you'll get pension as well after you will retire.
That's right. So my aim is wealth creation. There are no specific targets right now because one of my child is already
working,
independent. The other child also is studying medicine, likely to be independent after 2-3 years.
Okay, excellent. So the good thing is, I think you've managed to save up a good chunk of your money, 1.1 crore in debt, that's pension, your PFs and PPFs, etc., and 1.2 crore in mutual funds. And that also it's 50-50 between large caps and mid caps and small caps. Plus, he's going to get pension as well after 6 years when he will retire at 60. Okay, so Mr. Rego, at this age, at 54, like you mentioned, that thumb rule is 100 minus 50, right? So I suppose this proportion of 50%, roughly 50% in debt and roughly 50% in MF, I could, hazard a guess by saying that would get a thumbs up. But all in all, what do you make of the constituents of the mutual fund portfolio, as he goes into his wealth creation journey? How can he also, by the way, start reaping the fruits of these investments that he's made as he, steps into retirement?
Yeah, so I think, first of all, congratulations, and I guess you've built it up in a systematic way over a period of time, and I think this is the fruit of your disciplined investing, today, and also even at this point of time, keeping almost like a 50-50 debt equity, I think is a very good thing to do. You possibly also must be having some PF and stuff like that, which also would sort of be there, I guess. So how do you sort of, as you approach retirement, how do you go about it? First of all, let me also look at the fund side. I have just one small recommendation there that you can continue with some of the funds which are doing well, like Access Blue Chip, etc. Keeping in mind where the market is possibly you could look at a few multi-asset funds and do some allocation moving there, considering that some of the large caps have gone into pretty high valuations. So that is maybe one suggestion there. Now coming back to, as you come closer to retirement, I think you can start increasing certain funds like dynamic asset allocation funds. You can use an ICICI dynamic asset allocation fund. You can use an Invesco dynamic equity, and slowly grow that up so that you have something to also be a second level area where you can take out money on a slightly less risky way. Now on the debt side as well, the good thing is you have that 1.1 crore of debt, and that is something which you can also use for doing systematic withdrawals. Try and keep funds which can go above, let's say, 3 years, so that it becomes long term. And even if you do a systematic withdrawal, etc., then your taxation at a later stage will not be too high, keeping in mind that you're also getting possibly a pension out there. So I think it's good that you've done what you've done. Continue to just be a little disciplined as time goes by. Keep increasing your debt in a systematic way, and possibly use funds like dynamic asset allocation to give you a little bit of safety around it.
Okay, so that's the recommendation then, Ajay, for you. I hope this will help you in your wealth creation journey. Okay, Raghunath from Chennai joins us now on the phone line. Hi, Raghunath. What's your query?
18 months back,
yes,
in one of my investment in Sundaram mutual fund,
okay,
I invested 6 lakhs rupees.
Mm-hmm.
The amount assured was about 11 to 12%. But unfortunately, some 6 months back, I didn't receive any dividend
okay,
from the mutual fund. And is it right to hold it? Now, when I purchased, it was 14 rupees NAV.
mm-hmm.
Now it is only 10 rupees 50 paisa.
Okay.
Is it right to hold it or sell it off?
Okay, a couple of follow-up questions, sir. Firstly, you bought this 18 months ago and you chose the dividend option. It was a bulk investment. Is that right?
Around 6 to 7 quarters I received. Hello?
Yes, sir. Go ahead.
First 6 to 7 quarters I received regularly.
Okay.
Unfortunately, last quarter I didn't receive any. They skipped it.
Understood.
Only in December I received some money.
Okay, and you bought this 18 months ago only?
Yeah.
Okay, all right. Is this the only fund in your portfolio?
No, I am holding other portfolios which is doing very well.
Okay, this is the only problematic one.
I am having equities also.
Okay.
For about 15 lakhs worth. And mutual fund, including this, around 12 lakhs.
Okay, all right. Okay, so Mr. Rego, based on whatever information Raghunath has given us, what would you recommend? And this is the only, I suppose, underperforming fund for him. The rest of them are doing pretty okay, like he mentioned. 18 months ago is when he bought it, so it's still a short term. What would you recommend he do? Should he still, be a bit more patient with it?
Yeah, so unfortunately the details are a little sketchy, so it becomes a little difficult to provide an exact recommendation. But I'm assuming that he's probably invested in a mid or possibly even a small cap fund. Now, one point I would like to also caution investors is nobody can guarantee your return, and especially if you are looking at equity and you're looking at equity which is a higher risk asset. I think nobody can assure you a return. The second aspect is, you need to look at a slightly longer tenure. If you're looking at equity, maybe minimum 3 years, ideal would be something like a 5 years. Again, the other thing to be wary of is, doing lump sum investments, especially if your age is a little higher and it is an important part of your capital, then it may make sense to do a systematic transfers even if you have lump sum money. So now coming back to the Sundaram fund, I don't know how much of the erosion or the value is because, let's say, of dividends also, because dividends get paid out and they to that extent get adjusted from the NAV. Now let's assume that this is an actual real loss that has happened, which would mean that he's possibly invested in a small cap fund. Now markets have their cycles, and it's important to understand that we need to let the cycles pan out. And I think if it's a small cap fund at this point of time, because they've underperformed so much, and we also expect the cycle to turn at some point of time soon, it may make sense for him to continue to hold on to it. And even if he gets a dividend, ideally, at a time when, say, the NAV is down, it makes sense to possibly reinvest it into the same fund. So it's a difficult decision to actually go and put more money into a fund which is sort of underperforming for you. But one reference check that you may need to do before you actually take a call there is the fund doing well or not?
Okay.
Within its category.
Okay, unfortunately, Mr. Rego, we're just running short on time. We have the IIP data that we need to address as well. But thank you so much for joining in on this segment of the Money Show. Folks, if we've not been able to take up your query, email into us or call in on the number appearing on the top of your screens. I think we have to take a very quick break. We'll come back with the IIP data.